अग्रेसिव इन्वेस्टिंग, डे ट्रेडिंग जैसी टर्म्स सुनाकर आपको काफी लोग 200% रिटर्न्स, 300% रिटर्न्स का मंजन जरूर बेचेंगे, but there's a dark side behind it. Just like there's one behind the red subscribe button of our channel. Go ahead, give it a press, and you'll unveil the curtains like we will by exposing the real face of aggressive investing strategies, ताकि आप अपनी मेहनत की savings को fair and square तरीके से multiply कर पाएं. So without further ado, let's get into it. Investing in assets like cryptocurrency, startup businesses, and forex generally depicts a highly volatile nature. By using the term volatile for these particular assets, I mean they're usually unstable, unpredictable, and unreliable. The 3 U's. Many of you may disagree at this point, but by no means does this translate into the fact that there's no possibility of making decent profits. You might find someone from your friend circle who is into crypto and making a great living off it. That is definitely possible, but sadly, it's not the cup of tea for beginners to make 40, 60, or even 80% profits the moment they take their first step into investing. But before we dive into what are the right assets and strategies for beginners, let's discuss. Aggressive investing, things you should avoid. Let's have a look at a close to real life example. Let's say you open your phone and see investors and people talking about a particular stock. As a natural human behavior, you'll get curious and have a look at the company. You saw the price skyrocketing to the moon. You've got a few thousand rupees worth savings sitting in the bank. You feel excited that this might be a quick way to make a few extra bucks and feel the urge to quickly jump in the surging price. But after a while, the hype fades and your few thousand have turned into a few hundred. In investing, this is a typical scenario, especially for starting investors, which is also why it is said, slow and steady wins the race. Investing based on speculation. As mentioned earlier in the example of jumping into buying stocks, just because it was the hot topic does not guarantee that it will sustain itself. Unless you cash out fast enough before the hype starts to fade, which is very unlikely to happen, unless you get very lucky, but that would be called gambling your way into the stock market. What many beginners fail to understand is that you're buying and selling not just stocks, but real companies. As well-known investor Peter Lynch said, "I think you have to learn that there's a company behind every stock and that there's only one reason why the stock goes up. It's either because companies go from doing poorly to doing well, or small companies grow to large companies. So at the end of the day, what matters is whether the company is doing great or not. No matter how great the hype is, it does not matter if Salman Khan himself is advising people to invest in a stock. If the company itself is failing to make good profits, then the stock is 100% guaranteed to fail." Applying the principles of being fearful when others are greedy and being greedy when others are fearful will come in handy for you to know the right place to enter or not. Being too active. Now, being active doesn't only apply to buying and selling. Some investors always look at the charts of the stocks they are holding and it's like praying for it to go up. Like, hey Bhagwan, aaj stock at least 10% rise karwa do, main baaju wali mandir mein aarti chadhaunga. But it doesn't work that way. The stock market doesn't care about you cheering for the companies you hold. And you can even panic yourself by doing this since you always see the ups and downs of the market. This can lead you to make irrational decisions like being frustrated that after you bought the stock, it suddenly dropped, or getting hyped when the stock suddenly rises and end up buying more shares again and again since you can see those small gains. One more thing, when you actively participate in the buying and selling of stocks, this also puts you at a disadvantage since you incur unnecessary fees and taxes. Now, you may not notice it in the short term, but in the long run, fees also compound. As John Bogle said, where returns are concerned, time is your friend, and where costs are concerned, time is your enemy. In the stock market, what we want is compounding to work for us, not against us. Now, the third mistake most investors make is unplanned investing. You've already heard the saying that if you don't have a plan, then you're planning to fail. This is also applicable to investing, but to start having a plan, you first need to create a goal. For someone who's looking to retire early based on the dividends you get yearly, with that in mind, you should create a plan based on the goal to buy great companies that are undervalued and that give off a good amount of dividends, and to reinvest every dividend in capital gains you get to the cheapest company in your watch list to maximize the effect of compounding interest. If you take this strategy as an example, our plan revolves around our goal, which is to get high dividend yield stocks and reinvesting them back into more high quality stocks. So, moral of the story is, having a plan also provides motivation, since when creating one, you provide milestones for yourself, and when you achieve your milestones, you get that sense of fulfillment, making you want to move further to achieve more. This is what we call the dopamine trail, which can really help you stay in it for the long run. Mistake number 4 for today is investing the money that you need in the short term. Though this mistake applies every year, but it has particular importance in this year, which is very likely to be another volatile year. Long story short, because short-term investing is unpredictable, we don't know what's going to happen over the next year, and even if we did, we don't know how the market is going to react to it. So the result of that should be that whenever you're putting money into the market, expect that you'll not be seeing that money again or be able to pull that money out for a decade at least. Some people say 5 years, but even over a 5-year period, there have been times when markets have been lower than they were 5 years before. And that doesn't mean that you should be investing out of fear. In short, don't let the liquidity of the stock market lead you to think that it's easy for you to get your money out of it. You should look at the stock market in the same way that you invest in real estate. When you buy real estate, you're not really expecting to be able to turn around and sell that property tomorrow if you need it. You're hopefully investing in that property over a decade or more, and you should think about stocks the exact same way. It is important to remember that investing is not a get-rich-quick scheme, but rather a way to grow your wealth over time. It takes patience and discipline to stay invested during market downturns and to resist the urge to sell when there are short-term losses. By staying invested for the long term, you give your investments the opportunity to grow and potentially compound over time. This was all for today. Let us know in the comments if you'd like us to create a part 2 of this video. Till then, Omega Finance signing out.